Hey everyone, and welcome to today's Explainer. We've got a truly fascinating topic to unpack today. We're going to be diving into a deeply insightful analysis by senior banker Zafar Masud, which was recently published in Dawn. He presents a really compelling case about Pakistan's critical economic trajectory, and he asks a massive question. Is the nation on the verge of a huge export-led transformation? So let's just dive right into this and see exactly what the data and the recent structural shifts are actually telling us.
All right, let's start with Section 1, Pakistan's economic tailwind. To figure out where we might be headed, we first really need to understand the current momentum. Specifically, the stabilization that's been achieved under the recent 37-month IMF Extended Fund Facility, which was supplemented by the Resilience and Sustainability Facility. And honestly, this stabilization has been surprisingly decisive. It's basically setting a brand new baseline for the country's economic potential. The sheer scale of the turnaround is massive. Get this, Pakistan's foreign reserves have nearly doubled to an impressive $14.5 billion, but that's not just happening in a vacuum, right? It's occurring right alongside a historic primary surplus of 2.4% in fiscal year 2025, a narrowing fiscal deficit, and inflation actually dropping below 5%. This solid footing is exactly what has led to successive sovereign upgrades by major rating agencies like Fitch, S&P, and Moody's.
But beyond just the macro numbers, the geopolitical sentiment is shifting favorably too, especially in non-traditional export-oriented sectors. Take this massive $7 billion figure, for example. That represents the financial closure of the Reko Diq mining project in 2025, which is backed by major international heavyweights. Add to this the historic privatization of Pakistan International Airlines, or PIA, which is closing after a nearly two-decade hiatus. You see, these aren't just your everyday transactions, they are massive votes of international confidence.
And that brings us to the central narrative hook of Masud's analysis. With all these massive headline transactions and stabilizing indicators, is this Pakistan's Vietnam moment? Could these initial sparks actually trigger a sustained export-led economic takeoff, kind of like what Vietnam experienced over the last few decades?
Let's look a bit closer at that in Section 2, the Vietnam comparison.
To really ground these abstract macroeconomic concepts into something real, the author draws a pretty stark comparison. Both countries actually have remarkably similar-sized economies. Vietnam is at $476 billion, and Pakistan is at $410 billion. But look at the foreign direct investment gap. Pakistan attracted $2.46 billion, while Vietnam dispersed over $25 billion. That is roughly 10 times the investment flowing into an economy of a comparable size. No small difference, right?
And you know, this disparity doesn't just matter for a single isolated year. It compounds historically. Because of that sustained influx over time, Vietnam now holds a cumulative FDI stock exceeding $322 billion, which is equivalent to two-thirds of its entire GDP. Pakistan, on the other hand, hovers around just 8%. The investment to GDP ratio paints a really similar picture, with Pakistan sitting at about 13% against a regional average that's much closer to 30%.
Let's broaden the regional context just a bit more to understand the structural gap that still needs bridging here. If we look at private credit to GDP, Pakistan sits below 15%, whereas neighboring India is over 50%. The author neutrally points out that these gaps reflect a risk transmission system in Pakistan that simply hasn't matured to the level the economy actually needs to sustain its recent growth.
Moving right along to Section 3, institutionalizing the stabilization.
This leads us directly to the author's core thesis. What do we actually mean by institutionalize in this context? Well, it means transforming these recent extraordinary financial rescues into a permanent system of rules and structures. Basically, it's about making sure the economy no longer depends on emergency, one-off interventions just to survive. It is all about predictability. And the source text outlines a very specific blueprint for exactly how to achieve this.
Which brings us to Section 4, the 4 pillars of reform.
Here's the clear mental map of the author's proposed solutions. Step 1 is anchoring reform in legislation. Step 2 is strengthening regulators. Step 3 is advancing privatization. And Step 4 is building domestic investors. Let's break down how this builds, step by step.
Step 1 focuses heavily on legislation. The author suggests utilizing the newly established Tax Policy Office to embed core economic commitments directly into primary legislation. This includes securing things like the National Tariff Policy 2025-30, the Special Economic Zone Framework, the Export Refinance Regime, as well as IT and minerals policies.
Crucially, though, these should all have sunset clauses of no less than 10 years. Now, why does that matter so much? Because embedding policies with 10-year guarantees creates the exact kind of long-term predictability that foreign capital demands before they'll even consider entering a market.
Step 2 is all about regulators' autonomy. Pakistan has already made some really important strides here, particularly with the state bank's operational independence. The author argues that this same level of autonomy must be extended outward by giving fixed tenures, transparent appointments, and clear performance mandates to bodies like the Securities and Exchange Commission of Pakistan, NEPRA, OGRA, and the Competition Commission. The country can actually create a permanent level playing field.
So the really crucial point here is how this ties into current mechanisms like the Special Investment Facilitation Council, or the SIFC. The author views strong, independent regulators is the key to transitioning the current momentum generated by the SIFC into long-lasting, permanent institutional trust. It's really about evolving from just mere facilitation to a permanently regulated, healthy investment climate.
And now we hit the immense financial urgency behind the third pillar. State-owned enterprises have absorbed accumulated losses topping 2.5 trillion rupees. That is a staggering number, and it's exactly the kind of massive contingent liability that the IMF Extended Fund Facility was specifically designed to extinguish. It's just an unsustainable bleed on the broader economy.
So, to stop this trillion-rupee bleed, Step 3 calls for highly decisive action on privatization. The author outlines specific targets here. Capitalize on the momentum of the PIA privatization closure, proceed aggressively with the airport outsourcing process, and fully execute the prioritized list of 27 state-owned enterprises that are currently sitting at the Privatization Commission. Additionally, the text suggests reworking the Pakistan's Sovereign Wealth Fund to ensure it actively enables divestment rather than just warehousing all these inefficiencies.
Okay, let's pivot to the fourth and final pillar, building the domestic institutional investor base. This is an area the IMF program doesn't directly address, but the author argues it is absolutely vital. Consider this. Pakistan's mutual fund industry manages assets equivalent to about 4% of GDP. Now compare that to regional peers. In India, it's 17%, and in Malaysia, it is over 30%.
The gap is just as wild when we look at pension assets. They sit below 2% of GDP in Pakistan, compared to an emerging market average of around 20%. Now, you might be wondering, why does this domestic gap even matter for international growth? Well, the author explains that foreign investors take their cues directly from local ones. A robust domestic financial sector acts as the backbone to promote local entrepreneurship, and, crucially, it signals to the outside world that the market is safe, active, and ready for business.
And that brings us to our final section, seizing the Vietnam moment.
We've seen the stabilization, we've compared the data, and we've walked through the 4 pillars of reform. So what is the actual payoff? First, a really crucial point of clarification from the text. This is a fiscally light agenda. As sweeping as these reforms are, legislation, regulatory autonomy, privatization, and domestic investment building, none of them require loosening the primary surplus. They don't require departing from the state bank's monetary stance or undoing any revenue mobilization. These are essentially shifts in credibility and governance that cost the exchequer very little but signal an immense amount of trust to the global market.
And if those signals are received, the high-stakes payoff is absolutely incredible. According to the analysis, simply lifting Pakistan's foreign direct investment to just 3% of its GDP, which, by the way, is still only half of Vietnam's ratio, would generate an additional $10 billion in annual inflows. Let that sink in. That is more than the entire current extended fund facility disbursement happening every single year.
I really want to draw your attention to a powerful quote from the author, Zafar Masud. He reminds us, Vietnam was poorer than Pakistan in 1990. Today, its per capita income is more than double ours. The difference is not capital. It is conviction sustained over time. I think this brilliantly encapsulates the underlying principle of all 4 of those reform pillars. Credibility is built by narrowing the gap between what a country announces it's going to do and what it actually delivers.
So, the macroeconomic groundwork is clearly in place. The geopolitical alignment is rare and it's supportive right now, which leaves us with the ultimate question. With the world watching, will Pakistan sustain the conviction needed over the next decade to actually seize its Vietnam moment? It's a historic economic crossroads, and the roadmap is right there. It's just a matter of staying the course. Thanks so much for joining me for this explainer. I really hope this breakdown gave you a clear, structured view of the data and the path ahead.
Keep analyzing, keep questioning, and I will see you next time.